and welcome to another episode of Technical Insights. Phillip Almeida, and I, Sharon Taylor, are standing in front of the RBA building in Collins Street in Melbourne at peak hour, so it is a little bit noisy, I apologise. But we've got a segment today on the RBA and the cash rate, so I'm going to ask Phillip, what is the RBA?
Thanks, Sharon. So the RBA is the Reserve Bank of Australia. The RBA's role is making monetary policy decisions, and the cash rate, which is the meaning of the cash rate.
Yes, that was my next question.
The cash rate is basically the rate that overnight banking sector makes in terms of defining the interest rate out there.
So, Phillip, can you tell me what influences the RBA in them making their decision?
Yeah, so RBA look at a number of factors. They look at the interest rates out there in the economy, whether they're up or down. They look at the relationship between lenders and borrowers, so that gives you a good relationship in terms of their behaviours. They look at inflation rate targets, which is really important. Look at the value of the Australian dollar, import, exports, jobs growth, and basically economic activity and the strength of the economy and how it's going.
Well, I know it's very interesting, and I know you love this topic. How does the RBA cash rate affect the property markets in Australia?
Well, if you've got a mortgage, often you're always looking at the cash rate. So if they increase the cash rate, then your ability to service your debt becomes harder. There's not as much disposable income out there as well. In effect, if they lower interest rates, then your ability to service more debt, you actually go out there, you take on more loans, you go and look at the amount of investment activity out there, and then you basically look to go and invest or buy your principal place of residence.
Yeah, okay, so we know that we're in record low interest rates at the moment, 1.5%.
1.5%.
So there's not much room to go other than up.
Correct.
How do you see this affecting the property market?
Well, I think in terms of people's ability to actually fund debt is going to become more of an issue over the next 3 to 5 years. So you've actually got to pressure test your ability to service the debt over the next 3 to 5 years. You've got to be very careful that you can take on extra interest rates at 7, 8%, 9%. Long-term average, Sharon?
Well, long-term average is 7%, and we saw that in the 1990, the top rate of 17.5%.
17.5%.
So we haven't seen anything like that in our generation.
And your parents back in the 1990s?
Yeah, my parents, I know in '89 they bought into a business, they bought a house, and to think that that was the interest rate that they were paying at the time, it's hard to comprehend.
Well, if they can do it, we can do it.
Yeah, very positive. Thank you for listening. Phil's also written an article on this topic, so you can find that on performancedata.com.au as well.